Okay, we are back. I'm very happy to have Professor Lewis Mandell on the Goldstein on Gelt Show. He's the author of 22 books about financial advice. His latest is called What to Do When I Get Stupid. I saw his article on MarketWatch called Why Strategic Investors Don't Rebalance Their Portfolio. And well, that's really what I wanted to talk about today, Lou. Why don't strategic investors rebalance their portfolios?
Well, strategic investing basically says you have to identify what's really important to you and where you don't want to take any risk. And then you fully fund the income that you need, particularly as you approach the end of life, get close to retirement, enter the last stage, and you have no work income coming in, so you're living pretty much off your investments and any other pension types of income you might have. And probably the best strategy, at least in my view, in these very, very economically uncertain times, is to fully fund the expenses that are core to you, that you really would really make a big difference in the quality of your life if you lost, and fund them with investments that entail no risk at all, or virtually no risk. And then once those are fully funded, if you are capable of fully funding them, then the other part of your financial assets, you can do whatever you want with them. And this differs remarkably from the usual prescription of having a balanced portfolio and balancing according to the risk profile of the individual, which to my mind never really made an awful lot of sense.
So let me just start with the basic, because just your terminology, you refer to this as strategic investing. I spend a lot of time talking about strategy. In fact, I recently came out with a book about how the strategies of chess can be applied to investing, and I wrote the book with a world chess champion. And although, on the one hand, I think that she would agree with his concept of not taking risks, even though a lot of people say, well, the chess champions are always taking risks. You know, when you look at a game of chess, there's always some level of risk. In the same way, I would think there's some level of risk in a portfolio, not the least of which in your model would be, let's say, inflation or taxes.
Okay, the inflation risk one can hedge, at least in the States, by buying Treasury inflation-protected securities. I think anyone in the world can buy those. And from my experience having lived in Israel, there are a number of investments that you can buy, secure investments that are indexed for inflation. So you can hedge away inflation risk. And what was the other risk you mentioned, Doug, besides inflation risk?
I thought taxes were a risk. There's another word. The government simply might change the rules on you.
And I think you're right. And you cannot hedge away every single risk. In the American election, for example, there's a candidate running who's been a socialist. And so there could be a great deal of tax risk involved there. But there are ways, I think, of minimizing the amount of tax risk. One can buy, to the extent they're available, tax-exempt types of securities. And so it may not be possible to avoid every risk in life. I don't think it is possible. But it's possible to minimize the amount of financial risk by just not investing in assets that have a high degree of historical volatility.
Okay, so before we get to that side of it, let's focus a little more on this inflation question. One of the guests I had recently, an expert in Social Security, pointed out that Social Security is linked to inflation. And I said, yeah, but that's great. But when you have people who are getting older, their measure of inflation is not the CPI, meaning their expenses are not just going up at the rate that the overall inflation rate is, in particular because of healthcare problems. So when someone wants to buy, let's say, a TIP, a Treasury inflation-protected security, that's not necessarily going to cover him at the period in his life when he needs it the most.
Well, that's true. I mean, the current American Social Security system actually is very favorable to many retired individuals because of the adjustments that it has. But there's no such thing as complete protection. Now, in my system, one would attempt to protect oneself through insurance, so that the amount of loss that one could stand is the maximum loss. So if you do not have total coverage for health insurance, and very few Americans have total coverage, you probably want to structure it so that your downside risk, so that your out-of-pocket uncovered risk, is something that is affordable to you. But you are right. I mean, there is no way to totally guard yourself against risk, but that doesn't mean that one says, okay, since I can't do it, why not invest in securities with historically high rate of volatility, such as common stocks, in order to fund the core component of retirement that I need to get me through to the other side.
We're talking with Professor Lewis Mandell, who's actually spent time in Israel and had been in the past. He was a visiting professor with the Bankers Association here in Israel. He's written 22 books about investing, so he's certainly an expert in teaching people about how to handle their money. But it seems, quite frankly, Lou, that even though you're a very popular writer, we've seen you all over the place, from the New York Times to Money Magazine and The Economist, your take on this is a little bit differently. In particular, a lot of people will say that over the long term, the stock market is a good bet, even though there's a lot of volatility, and they'll encourage people at all ages, including retirees, to have a significant portion of their money in the stock market, simply because when they look at it over time, it actually seems to do better. Are you just being ultra-conservative, or do you think those people are wrong?
There's always a question of whether history is a very good predictor of what's going to occur in the future. And if we look at securities, and I have to say, my entire life, I've invested the bulk of my investable assets in equities, and I think over a long period of time, there's never been historically a 20-year period where equities have not outperformed any other class of assets. But if you're 75 years old, a 20-year holding period horizon doesn't look all that reassuring. And in addition to that, we've had a market returns over the past at least 16 years in the United States that have been dramatically below the historical averages. I mean, on a non-inflation adjusted basis, we've always used the notion of 11% total returns on, say, the U.S. market index, the S&P 500, and there are very few people who are predicting that we can use 11% going forward, particularly given the very low growth rates, not only of the U.S. economy, but more pointedly of many of the world's leading economies. So are we looking at, say, a real return of 9%? Are we looking at a real return of 7%? Do you want to bet your comfort in your old age upon even getting that 7% real return? And what I would say is, if you have the assets, why take any risk with that portion of your assets that you need in order to secure your basic comfortable retirement? And why not fully fund that with the least risky assets you can find, and partition your portfolio in that manner, rather than taking what we generally teach in academia, capital asset pricing model, which is based upon some theoretical notion of utility curve, as if people have some idea of what their utility curve even looks like.
Right. It's one of the things, frankly, that I talk to clients about. My day job is that I'm a financial advisor, and I'll often tell my retired clients, I'll say, listen, you should be spending a lot more time thinking about your vacations and spending time with the kids and grandchildren, rather than thinking, oh my gosh, I better call Doug because I see that the market is shaky. So I'll tell them, if we can design a portfolio that can assure you that you'll have enough money to pay the bills every month till you die, let's start with that. Everything above that, great. Then you want to talk about risk and growth, I have no problem. But frankly, I am with you in the theory that we need to make sure that people are safe and not just comfortable in terms of how it looks on a chart, but they have to be able to sleep at night. You don't want someone, I don't want a 75-year-old client not being able to sleep that I'm adding another reason on because I put him in a portfolio that has risk, even if on paper it's a good idea. So let's wrap up, Lou, with I want to go back to the beginning of what we said, which is you suggested people shouldn't rebalance their portfolio, which is the model that once every period, let's say once a year, you go back to whatever your initial asset allocation was. So if you had a 50-50 asset allocation between stocks and bonds, you'll adjust your portfolio. Why do you come out against that?
Well, because, the basic strategy here that I think you and I agree upon is that one partitions and one fully funds those core expenses for the rest of one's life, as well as one can with very, very safe investments. And then the other portion of it, assuming you're fortunate enough to have additional financial assets, you can let ride. And there's no real need. So if they're invested in equities and the equity market has been bullish and you're doing really well, and now all of a sudden you find that your equities are no longer 50%, but they're 60% or 70%. There's no reason to rebalance. Alternatively, if you find that the assets you have, the core assets that you have for whatever reason are no longer quite sufficient to make it to the other end, then you may want to take some of your financial assets and do that. So rather than stick to strict balance, which is what really the bulk of financial advisors of my acquaintance will tell you to do, I would rather just do what you and I discussed earlier, and that is fund what is necessary and essential for you so you can sleep at night, and then let the rest of it ride. And as I said in my Market Watch article, if I have those additional assets, and my ultimate aim is to fund a classroom at Tel Aviv University where I taught for a while, why fund a classroom if you can fund an entire building or even have an entire business school named after you?
And I hope that we will all have the opportunity to do that. Professor Lewis Mandell, I really appreciate your spending the time. Tell us in the last few seconds, how can people follow you and follow your work?
Well, my most recent book is What to Do When I Get Stupid, and it basically says, hey, strategic investing is the way to do it, and as we get older, we cannot really predict how reliable we will be. In other words, as we age, there are certain things that we may end up doing that, as we're younger and more rational, we would not wish to do. And so, putting one's finances on automatic when one is still totally compos mentis is a very good idea. And the book also goes into strategic investing as a way of setting up your sort of methodology and strategy for the rest of your life.
All right. And people can also contact you through your website as well.
Absolutely.
All right. We will put links to all of that at the show notes of today's show at goldsteinongelt.com. Lou, thanks so much for your time.
It is a pleasure, Doug. Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world. If you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.